Hi everyone, and welcome to our summer 2023 client briefing. I'm Adam Thurgood, managing partner of Hightower Las Vegas, and I'm joined by Raina Penalova, our director of research. It's been an interesting few months, hasn't it?
Absolutely. So much has happened in the last 3 months since we last recorded the client briefing, and both here domestically in the US and internationally with geopolitics and everything going on. And the stock market has been having a pretty nice run so far this year, despite the little correction we've experienced the last couple of weeks. But this whole rally has been strange underneath the surface, hasn't it?
Yeah, it really has, and we'll get into that a little bit later. We thought that the best approach for today's client briefing would be to have an agenda that answers a series of questions. So the questions that we're going to answer today are: what's fueling the equity rally? Is it sustainable? Why haven't we seen a recession yet, given that all the leading indicators are pointing in that direction? And then, can we avoid a recession? And finally, given everything that's going on, how are we positioned? So let's start with the equity rally and what's behind it. There are a few different factors that have pushed the stock market forward this year. Over the last couple of months, the market's really started to price in a soft landing scenario, which is where growth slows down but doesn't go negative, and then it allows us to rebound from there. It's obviously good for corporate earnings, and that in turn is good for the stock market. We've also seen the stock market cheer the fact that 4 to 5 rate cuts by the Fed are priced in by the end of next year. That eases financial conditions and makes it a more attractive environment for equities. But the biggest factor by far of this equity rally is really the performance of the tech stocks as a result of the optimism around artificial intelligence. We've seen a big leap forward in AI this year with the release of ChatGPT, and a lot of the biggest tech names have talked about AI on their conference calls, and that has really enthused investors and put a lot of demand for those shares, which has pushed up prices. It's important to remember that the S&P 500 is market cap weighted, which means that each company's weight in the index is determined by their overall market cap, which is the number of shares they have outstanding multiplied by the price. And when the biggest names in the index are being fueled by optimism, in this case around AI, that's going to pull the entire index higher. So we've seen the S&P have a nice run since March. It's up about 14% year to date. But that blue line there is the equally weighted S&P, and it's only up about 4%. So the average stock is actually not performing all that well. And that's the kind of gap that we typically don't see too often.
Absolutely. So it kind of makes you think, is that rally really sustainable? And that parabolic move in AI-related stocks was absolutely astonishing, wasn't it?
Yeah, it was funny to see people tracking how many times AI was mentioned on conference calls and things like that, and how it correlated to the stock market performance. Well, let's get into whether this rally is sustainable. You know, on a valuation basis relative to treasuries, there's a way that we can look at a metric to make those side by side, and it's called the earnings yield. If you think about the price to earnings ratio as the number of years of earnings it takes to equal the current price, the inverse of that is the earnings yield, which you can then compare to, say, the 10-year treasury yield to see what kind of risk premium is being placed on equities. And that has narrowed significantly over the past 12 to 18 months. The spread is actually, which is on the bottom panel there, as tight as we've seen in a couple of decades, meaning that the relative attractiveness of stocks versus bonds has narrowed significantly. Now, that doesn't mean that the stock market can't perform well. We saw the stock market do quite well in the 90s, even with a negative risk premium. But it is an indication that there are other alternatives out there rather than just stocks. On a liquidity basis, the market has really diverged from the liquidity component. What do I mean by liquidity? Well, it's basically the amount of money sloshing around the system. It's the Fed's balance sheet plus a couple of other factors that determine how much money is in the system. And we've seen a very tight correlation between liquidity and the S&P 500 over the past 5 or 6 years. But recently, because of that optimism in those large stocks around AI, we've seen a divergence between how the S&P has performed versus the liquidity index. Now, in order for us to see the market move forward from here, we think that liquidity conditions would need to improve, and that may prove challenging because in order to get liquidity moving higher, you would either need the Fed to start supporting markets, which would mean an end to quantitative tightening and maybe even more quantitative easing, or you'd need more loan growth. And the problem is that the Fed is not really going to be easing financial conditions when the economy is growing at 6 or 7% nominal GDP. And then also loan growth is a challenging environment right now because banks are tightening credit conditions. So without liquidity moving higher, the stock market may have a rougher road ahead. If we consider the possibility that there's still a recession on the horizon, then it does suggest further downside for the S&P 500. This top chart here is the unemployment rate with the red bars denoting recession. And you'll notice a similar pattern. When the unemployment rate starts to tick up, you typically have a recession that emerges. And the bottom panel is the S&P 500 drawdown. And what you'll notice is that doesn't usually end until well after we've seen a recession or a rise in unemployment. So we still have a ways to go before we get there.
Yeah, and we still haven't seen recession, even though so many strategists and economists projected one for this year. Which is
and you know, the leading indicators have been pointing in that direction for a while. So, you know, begs the question, why haven't we seen a recession?
Yeah, absolutely. So, very simply, we've experienced these very high levels of employment still. You could even argue that the CEOs are becoming even more optimistic on the margin and reluctant to let go of people just yet because of that resilient stock market. And also, we're running record high deficits. A deficit of 8.5% hasn't been seen outside of recessionary or war periods in the past. And what's more, the Congressional Budget Office projects for these deficits to persist in the future. Now we can have a whole other presentation on how this is absolutely unsustainable in the long run. But still, government spending comprises about 20% of GDP on average, and running a deficit supports the GDP growth. So we can argue that these high deficits right now are helping us avoid recession at the moment. But we still shouldn't lose sight of the fact that these recessionary indicators are associated with long and variable lags. For example, the Financial Conditions Index first became very depressed and triggered a recessionary indicator about 15 months ago. And this particular indicator in history has been associated with a lag of between 10 and 28 months between the time the indicator is triggered to when recession actually starts. The same thing goes for the yield curve, and this is something that we frequently cite here. So the 10-year interest rate on a government bond first went below the 2-year interest rate about 15 months ago, which once again is well within the historical lags. And again, the same goes for new home affordability. It first became very depressed, triggering recessionary indicator in 19 months ago, and we have all the way till as long as 34 months, or we have had as long as 34 months in the past before recession actually started. So that begs the question, can we actually avoid recession?
Yeah, the leading indicators, at least most of them, are at levels that are pretty depressed and would suggest a recession is sort of baked in the cake. But the market's pricing in a soft landing, so what gives?
Yeah, we should definitely look at both leading indicators and some scenarios that the market is pricing in and see what we think is the highest probability. Let's first look at some leading indicators like the leading indicator index. This is a composite of 10 different leading indicators. We again talk about it pretty much every time here on the client briefing. It has been declining substantially, and in fact we just posted the 16th consecutive lower reading in this measure just the past month. So usually a decline of 4% year over year for the leading indicator index has signaled a recession in the past. Also looking at something like this small business optimism also is remaining depressed still, and the consumer sentiment index, even though it has rebounded in the last few months, is still very depressed. So leading indicators are pointing towards a slowdown, but we should still examine the probability of a soft landing happening. Perhaps we just slow down a little bit and then accelerate from there. So this is the first scenario that we're going to study today. Let's say that perhaps we do have some labor market weakness, but not very high. Maybe unemployment levels just tick up by 0.5%, not something more material that would trigger an outright recession. But perhaps by that time, inflation is already very low. Maybe it's running below the Fed target, at levels that are below the Fed target of 2%. That is absolutely possible in our opinion. And let's say that the Federal Reserve, wanting to avoid a crisis or a very material slowdown in economic growth, implements really quick rate cuts or starts quantitative easing right away and supports the economy. We think that that would be possible, but unlikely right now because of the very material constraint and threat of a secondary inflation wave. And we know that the Federal Reserve is worried about a secondary inflation wave because they tell us they are pretty much every chance they get. At most press briefings or interviews they conduct, they do discuss the threat of the secondary inflation wave. And we do think that that's for a very good reason. Looking back at past inflationary periods, such as here we have the inflationary periods of the 1940s and 1970s as well. In both of these instances, we had initial inflation wave, the initial inflation surge, only to dissipate quickly and come back with a vengeance shortly after. We really want to avoid this type of scenario this time around, because it would mean that we would need to endure central bank fighting inflation and higher interest rates for way longer than we currently anticipate. And this process is bound to be very painful for both the government, having to pay higher interest rates on the government debt, and for us consumers. So let's say we don't need to cut interest rates. We just simply accelerate from here. This is the so-called no lending scenario, or the second one we're going to explore today. Let's say that high interest rates are simply okay, and they have been so far. We have been dealing with high interest rates for a few months already. The tightening cycle started about 18 months ago, and growth is still chugging along. Maybe we even have growth rebound from here. And again, that's absolutely possible, especially with things like the Inflation Reduction Act or the CHIPS Act that involve high levels of infrastructure spending. Those act stimulatively to the economy can absolutely accelerate growth from here. Now, for this scenario to really work out and to prevent the Federal Reserve from further hiking interest rates, we would also need for commodity prices to behave, which Adam is going to discuss a little bit later, of how it's a little bit harder for that to really occur. But let's say that maybe China experiences a recession, puts pressure on commodity prices, and they do not rise significantly, even in the case that growth rebounds from here. We still think that that scenario has a material constraint related to the first condition, higher interest rates being okay. Higher interest rates are okay right now because, as we know, many consumers were able to lock in low mortgage rates for an extended period, and the same is true for the corporate sector. They were able to lock in the low interest rates for their loans, and even right now are receiving pretty nice interest on the cash that they have on hand. But as we can see on this chart, which depicts the debt distribution for the corporations in the US, we have a wave of loans coming due starting the second half of 2024. So if interest rates remain high at that point, the corporate sector is bound to feel the pain of higher interest rates finally. So is this something that we're on the lookout for? I mean, I would think that everybody should be looking out for credit issues right now.
Yeah, well, a credit issue would be the trigger that sends us from a soft landing scenario into something more pernicious. And so we've obviously got to keep an eye out for that type of an outcome. One way to do that is look at bankruptcies, and we've seen corporate bankruptcies tick higher, actually materially higher over the past 18 months or so. But if we zoom out, it's not as bad as it looks. This is the Bloomberg Corporate Bankruptcy Index. It measures not only the magnitude of bankruptcies, but the number as well. And we can see that it's moving higher, but it's far away from the periods of stress that we've seen where this index tends to get up, 2 to 300. So we have a ways to go there, but we want to know where it's headed. And one way to do that is to use the ISM Manufacturing Index as a leading indicator of bankruptcies. It leads by about 6 months, and you can see here that it's projecting bankruptcies are going to increase substantially over the next couple of quarters. We can take this one step further and look at how where the ISM Manufacturing Index might go by looking at the New Orders Index. And while it's still in contraction at below 50, it does look like it's finding its footing a little bit. So if we saw new orders pick up from here, that would be a sign that we don't really need to worry about the bankruptcies that are rising. But if we see new orders take another leg lower, that could be a really, really troubling sign for the economy and the markets. So I guess the big question is, what are we going to do about it, and how are we positioned?
Yeah, so many different outcomes that can happen right now, right? So positioning is tricky in this environment.
Yeah, the good news is that cash is actually paying something versus a couple of years ago. And in the words of Warren Buffett, cash is king, especially in times of crisis. If you followed what Warren Buffett's done with Berkshire Hathaway, they tend to carry a lot of cash because they want to be able to pounce on opportunities. And today, with cash yielding over 5%, or cash equivalents yielding over 5%, we think it makes a lot of sense to have a chunk of the portfolio in reserve waiting for an opportunity. We're also very bullish structurally on the commodity space over the next 5 to 10 years for a variety of different reasons. When you think about energy in particular, it's had a lack of capital investment over the last decade, and we think that's going to lead to some supply issues going forward. But if we're worried about a potential second wave of inflation, energy and energy stocks have been a great place to hedge out some of that risk. Last year, 2022, was a tough year for markets. Basically, every asset class was falling except for energy because it was, part of the problem with rising inflation to begin with. The agricultural section of the commodity markets has been challenged from weather changes and disruptions to the war in the Ukraine, disrupting wheat supplies, so that's another area to consider. But the big one here is really what the world is doing with the green energy transition and the infrastructure spending that's going behind it. It's going to create an enormous demand for base metals, specifically conductor metals like copper and silver. Those metals are going to be tough to supply at the levels that we're going to need. And so we think that this kind of sets up a bit of asymmetry in the investment space for commodities over the next decade. And investment asymmetry is what you really want. It's a heads I win, tails I don't lose that much type of scenario. And while anything is possible, we think that the commodity space, particularly base metals, offer that kind of outlook. Uranium was a similar example. A couple of years ago, we were convinced that uranium was an asymmetric bet because it was so depressed and under the cost of production. And it's turned out to work out quite well. Uranium's up a lot over the past 18 to 24 months, and while we've held a small position, it's been additive to portfolios. We obviously want to remain diversified. The left-hand chart here is our long-term structural, our strategic asset allocation, where we have a significant weight to U.S. equities and some international equities, some small cap U.S. equities, as well as commodities and precious metals. But what you'll notice on the right-hand side is how we're currently positioned. We're underweight U.S. equities because of some of the valuation concerns that we discussed earlier, and we're actually overweight international equities because they tend to be more value-oriented and in the sectors that we think are best poised to perform well over the coming market cycle. And then, of course, we have a large overweight in precious metals that can be seen here, specifically gold. We've actually received some inbound calls about why we have an overweight in gold, and most people don't realize that over the past 25 years, gold's actually outperformed the S&P on a total return basis by just a small hair, and it's done so with almost no correlation to the S&P. So from a long-term perspective, gold is a great portfolio diversifier, and in a world where governments have lost control of spending and we have elevated geopolitical risks, gold makes a lot of sense to us. Now, even though we're worried about the near term and want to risk manage it, we need to zoom out and focus on the bigger picture. You know, the orange bars here are the price return of the S&P 500, so not including dividends. And then that blue line in the middle is the average rolling 30-year return of the S&P 500, excluding dividends. So you can add dividend yield on top of that. And you'll notice that while there's a lot of variability in the orange bars, there's not much in the blue line. It's consistently between 6 and 8% plus dividends. And so while we do think that we need to be concerned about the short run here, we're still very optimistic about the long run nature and return potential of the markets. So that's all we have for you today. Make sure to check out our other publications on the website where we have different videos and articles on the markets and the economy and the wealth management industry. And with that, we'll see you next time.